Hello, Sir Michael and friends. Today, our group one will present the purchase price of a company. Before I continue, let me introduce myself. My name is Chika from class 11.5, and I will be explaining the story behind the purchase price of a company. Now, some of you may have noticed that recently in several news media, there are companies who decide to merge or even acquire another company, either for cooperation or business expansion. Both merger and acquisition has its own benefits. But before we continue, do you know what merger and acquisition is? A merger happens when two or more existing companies combine to form a single new company, where later on they will share all the liabilities and assets. It usually happens between companies that are equal in terms of size and scale of operations. Merger is divided into two categories, known as horizontal merger and vertical merger. A horizontal merger is the merger between firms that produce and sell the same products or service. An example would be Indosat Ooredoo Hutchinson, which is the merger between Indosat Ooredoo with Hutchinson 3 Indonesia, where both provide telecommunication services. While vertical merger is the merger of two or more companies that sell different goods or services. As an example, Goto, which is the merger between Gojek, a multi-service company that specializes in transportation service, with Tokopedia, which is an online shopping commerce. Next, what is acquisition? Acquisition is similar to buying an existing business or the purchase of assets and liabilities of a company. This results in a takeover by the acquiring company, where the purchased company gets fully absorbed. The acquiring company could buy other companies with cash, stock, assumption of debt, or even buy with a combination of those three. An example of acquisition is Bank Sentral Asia, or in short BCA, buys their share of Interim Bank to support BCA's subsidiary company, which is BCA Syariah. Another example is MTech, which stands for Elang Makota Technology Company, buys the share of SAME, which stands for Sarana Meditama Metropolitan Company, which results in several Omni hospitals to change its name into EMC Hospital. Next, my friend Chintara will talk about the advantage and disadvantage of purchase price of a company.
Thank you, Chika. Now, what are the advantages and disadvantages of mergers and acquisitions for businesses? Well, in general, both merger and acquisition results in businesses expanding, where the business gains more assets which could be used to reduce unit costs of the product or service provided by the company. With lower unit costs, the products or services will gain more customers and also repeat orders. Thus, more profit is generated into the business. Besides that, merger and acquisition of companies implies companies combine into one, reducing the market competition and additionally securing a larger market share. However, there are some drawbacks from both mergers and acquisitions. First, while businesses combine into one, this affects the ownership and control of the company, since there's a new corporate governance. With new corporate governance, there will be more shareholders, which could lead to less dividends per share. Furthermore, in new corporate governance, adaptability must be needed to overcome the clash of culture between staff from company A and from company B. If the staff or human resources can't adapt with the new environment, then poor communication, coordination, and lack of motivation might happen, which will affect the company's growth. Now, what is a purchase price? When a company wants to merge with another company or acquire another company, the two companies must settle on a price before anything can go through. If the price is too low, the shareholders of the company can reject the acquisition or the merger. Once the purchase price has been determined, it's called the purchase consideration. There are two methods of calculating the purchase consideration, which will be further elaborated by my friends Jovita and Calista.
So the first method to calculate the company's purchase price or the purchase consideration is by using the net assets approach method. By using this method, the purchase consideration is calculated by adding up the values of the assets taken over by the purchasing company and subtracting it with the values of the liabilities which are going to be taken over by the purchasing company. The values of the assets and liabilities for the purpose of calculating the purchase consideration are those which are agreed upon between the purchasing company and the vendor company. For this method, a statement of financial position is used to identify the assets and the liabilities of the company being sold. If the transferee company agrees to take over all the assets of the transfer company, it would mean inclusive of cash and bank balances. The term all assets, however, does not include fictitious assets like debit balance of profit and loss account, preliminary expenses account, discount and other expenses on the issues of shares and debentures, advertising expenses account, etc. Any specific asset not taken over by the transferee company should be ignored while computing the purchase price. If there's any goodwill, prepaid expenses, and etc., the same are to be included in the assets taken over unless otherwise stated. Not only that, but the term liabilities will always signify all liabilities to third parties. Trade liabilities are those incurred for the purchase of goods such as trade creditors or bills payable. Other liabilities like bank overdrafts, tax payable, outstanding expenses, and etc. are not part of trade liabilities. Liabilities do not include accumulated or undistributed profits like general reserves, securities premium, workman accident fund, insurance fund, capital reserve, dividend equalization fund, etc. Now my friend Calista will now talk about the net payments approach to calculate the purchase consideration of a company.
Okay, thank you, Jovita. Now that Jovita has talked about the net assets approach method, I will be talking about the other method, which is the net payment approach. The way net payment approach works is that it takes the total of all the payments made by the purchasing company for the company being acquired. It will consist of shares, debentures, and cash offered to the shareholders of the company being purchased. In other words, this method sums up all the payment transactions that has been made to decide the value of the company's purchase price. Let's clarify it even further. Here, if we take a look from this example, we are given information of the shares and the cash, which can be used to calculate the purchase price. In this case, the first step is to find out exactly how much shares are being offered. We can calculate this by dividing the total value of the shares with the singular value of the shares from the purchasing company. In this case, it is 20 million pounds divided by 0.50 pounds, which results in 40 million shares. The next step is to calculate the new total sum of the shares in the company being acquired. In the question, it is stated that there will be one new share in Ngong International PLC for every existing share held in Mary Trading PLC at 0.60 pounds per share. This means that we can calculate the total value of the shares in the acquired company by multiplying the number of shares, 40 million, with the new value, 0.60 pounds, thus resulting in 24 pounds million. The last step is to add other remaining components such as the 1 million cash. Therefore, the purchase price is 24 million added by 1 million, which equals to 25 million pounds. And there we have it. Thank you, Sir Michael and friends, for listening to our presentation about the purchase price of a company. We hope that our presentation was informative and beneficial for future use. Thank you.